Hi CA students, let's revise CA Final AFM Chapter 5 Security Valuation. Practical question 31. Bank A enter into a repo for 14 days with Bank B in 10% Government of India bonds 2020-28 at 5.65% for 8 crores. Assuming that clean price be 99.42 and initial margin be 2% and days of accrued interest be 262 days. You are required to determine dirty price, then repayment at maturity, considering 360 days in a year. Now, let's see what is this dirty price. When bank enters into transactions, in case of this repo and reverse repos, the dirty price will be the price of the security excluding any interest accrued from the since the last coupon payment. In any type of security, once the coupon payment is made, usually on quarterly or half yearly or yearly basis, so that when the transaction is happening from the date of last coupon date till the current date, the interest will get accrued. So if the interest is accrued and the price is including the accrued interest, then it will be dirty price. Clean price will not include any interest accrued portion. It will have only the price of the security. So obviously dirty price will be equivalent to clean price plus interest accrued. In our case, they have given the clean price as 99.42. So to find out the dirty price, we'll add clean price plus the interest accrued. Now the interest accrued is nothing but 10% government bonds. So 100 into 10 by 100 into 265 days is the interest accrued divided by assuming 360 days. So calculating this, we are getting a value of 106.7, which will be the dirty price. And going further, repayment at maturity. Repayment at maturity is nothing but second leg. So what is this first leg and what is the second leg? When a bank enters into a transaction, the initial sale of security, when the borrower sells the security to the lender, it is called as the first leg, which ideally happens at a dirty price. And when the borrower again repurchase the security from lender at a higher price, including the interest or the repo rates, that will be called as the second leg. So it is repayment at maturity because the first initial sale has been the first initial sale of security is now been repurchased. So second leg will be done. At the repayment of maturity, when the second leg is happening, usually typically it is done on the clean price. So first leg minus second leg will be obviously the interest or the cost of borrowings. So once we calculate, here the requirement of the question is repayment at maturity, which is nothing but the second leg. So once we calculate the first leg, then if we add the repo rate to it, we can arrive at the second leg, which is nothing but replacement at maturity, repayment at maturity. So first leg will be nominal value of the security multiplied by dirty price by 100, as the first leg transaction will happen at dirty price, multiplied by 100 minus initial margin divided by 100. So in our case, dirty price is 106.70 and nominal value will be 8 crores and the initial margin given as 2%. So we are getting a value of 8 crore 36 lakh 52,800 as the first leg, which the initial sale of security happened between Bank A and Bank B. Then the second leg, which is the repayment of maturity, the start proceed, which is the first leg, 8 crore 36 lakh 52,800 plus the repo rate for 14 days, as the bank A enter into repo for 14 days with bank B in 10% GOI bonds. So the repo rate is for 14 days, so 14 divided by 360, as the question specifically mentions to consider 360 days, and the repo rate given as 5.65 percentage. So calculating, we are getting the repayment at maturity as 8 crore 38 lakh 36,604. Thank you.